Alright. Another Secret Wars episode dedicated to Stan Weinstein's training framework. I'm revisiting it. Did it back in the days, 2007 all the way to I think 2010, and then started moving away to do classical chart, doing it simple. But I realize now with my experience reading recently Stan Weinstein's book, there's a lot of stuff, a lot of details I wasn't doing properly, wasn't giving true value to the training framework. Although I remember back in the days it worked very well, especially for the 2008 downturn, and even for the 2009 upturn I was in. But I was too tight on my sell stops, getting triggered out way before the end of the move. It was all fun and games. It was good, but having known what I know today, I revisited some of those stocks I was in, and I would have rode them a lot longer. And that's the advantage for Stan's system. If you understand it correctly and you apply it the best way, you'll run those stage twos not from the bottom to the top, but you'll get a big chunk part of it. And that's why I'm revisiting it, to rehash it, re-see. Now there's a lot of people out there in the community, stageanalysis.net, chart screeners could run on Chartmill. There's StockTwits, and there's a whole bunch of information out there. People read the book, how they interpret it. So it's the perfect time, I believe, to redo it, contribute if I can with my experiences, and soak in what other people have done with it. So right now, what I have is data on the New York Stock Exchange. I have my my weekly candles, 30-week moving average, my volume indicator, my RSI. It's not the Mansfield, but it still gives me I could see when the RSI is going upwards or downwards and across the midpoint, and it helps me get that triple confirmation. I had the zigzag, which right now I'm hesitating to put because Stan had the 7%, any correction under 7% as a trader, omit. But I think we have to be more precise than that. Certain stocks have different type of volatility. And it just sometimes I rather go with I had this technique that I would look at the let's say the breakout was here, maybe this candle here, and the pullbacks, I would look at the RSI. If I had a V shape in the RSI, hit the bottom and go back up, then I know that that would be a good place to put my sell stop. And I might use that for some visual inspection. I could probably maybe calculate on the calculator to make sure that the I don't even know if about that 7% anymore. It's a good maybe guideline. So I think what we could take away from it is small corrections. Don't move up. Don't get too greedy. And maybe that's what I did back in the 2009 when the stocks were in stage 1 and exploding stage 2. On the smallest correction, and I wouldn't wait till the pullback reached almost the previous highs, and I just got triggered out because I was too scared. I didn't let the stock for it to move up. All right, so let's look at data. I'm still looking for candidates, and this one came to my attention of somebody from StockTwits. And no matter for what reason somebody would recommend a stock, it just gives me a ticker. And some people see it a certain way, why they recommend it, why they're bullish, or I just look at it and then I could analyze it either with the Stanway, which is my what I'm dedicated to right now, or I could easily just take my classical 10-year monthly candle chart trading framework and analyze it that way. All right, here it is. So this would I have no preoccupations either case. All right, so let's do the Stan way. That's what we're here for. Back with Stan. Okay, here I am. So I'm going to remove the zigzags, and this is a really nice stage 2, and even the trader would have been in the whole way. Trader, remember, if it violates a 30-week moving average and he's out for the remainder of his position. Stage 1, breakdown. Stage 3, breakdown, pull back. Then you could have shorted it some more. Then the final breakdown right here below this big pattern. And after that, sideways action, pulling less and less the moving average down, and it's eventually flattening out for stage 1 back again. So what do we have here? We have some resistance here. We had a slanted resistance line, which I'm not a big fan of, but it's still a trend line. If it's violated, it could give you some indication of a breakout. And what do we have here? Okay, volume. Okay, there's no super figure, Stan says, but if I remember, it's twice the average volume for the previous maybe 4 or 5 weeks. And this is definitely twice. Did we have RSI breakout? RSI going in from the over the 50 line. On the Mansfield would be 0 line. Going upwards, nice. We have that also. And we're above the 30-week moving average. And above breakout line right here. Maybe it was this one. There you go. So we have a lot of information. This was definitely an A++ stock early in April, May 2017. And even here, back here. So there's a lot of breakouts. There was a breakout before the breakout. Right here. Is it this candle? Yeah, this candle has twice the average volume. RSI going up and break above the 30-week moving average, break above the resistance. It's awesome. And you see the pullback here. So, okay, that's what I looked up today. Investors do most of their buying at the breakout, the beginning of stage 2. Traders about 75 to 80%. Investors do most of their buying at the beginning of a stage 2 breakout. Traders do most of their buying on continuation breakouts, during stage 2, about 80%. So that kind of caught me by surprise. Traders on the breakout, they would still buy, but they'd buy everything here on this candle, put their position, and after that, each continuation breakout, we'll look at them later. That's why I'm looking at this stock, because there's probably a continuation breakout move we could do. And investors, they would take half their position on the entry here, and another half, the other half of their position on the pullback. All right, another bit of information. Pullbacks, according to information I found on stageanalysis.net, pullback from good quality breakouts, maybe 1 to 3 months. So four candles to 12 candles, weekly candles. And right now, how many do we have? 1, 2, 3, 4, 5, 6, 7. See, so it's about the 1 to 3 months. 2 months, it did a pullback. So it's a good indication that this was a quality breakout. And the pullback was done with small volume compared to the breakout. So this is really a quality breakout, and you could really trust the pullback as a pullback that's just going to bounce off the breakout line. And you could put, if you're the investor, you'd put the remainder half of your position with no worries that this would continue. And I'm wondering if a trader could also add there. Maybe he could. I know they said to put everything on the initial position. I guess maybe that's in case I never pull back. But a pullback, I think it's a good continuation occasion for a trader or investor to add. So that's of note. Yeah, those are 2 points that I read up on today. And you see right now that it pulled back. You could have added on low volume, and then you had another breakout right here. So the pattern repeats itself. And then again, if you're the investor, you would have put half your position here, half there. Then you could have probably seen this as a continuation breakout. If you missed this complete original move, you could have probably added another half position here. And if there's a subsequent pullback, you could have added half more. So I'll know maybe this was the next pullback. And this is what I'm going to use now. The V's. I'm using the V's as on the RSI as pullbacks indicator. If I see the RSI going back up, then I know that the move has corrected and going back up to trending towards previous highs. It's going to help me visualize. It's easier to see on the line than on candle chart, where sometimes the candles kind of overlapped and they're small. For whatever reason, I might not see the pullback. Is it a 7% pullback or less? That's up for grabs. But I'm going to try to rely on more on the RSI right now. See how that works out. And did we have light volume? Yeah, the volume was relatively light. So another occasion to enter here. So you enter. Here are the few places where you could have entered. Right here, this point here. You could have added positions here on this pullback here, on this pullback here. So this stock is really A+ material. I say A++. Honestly, it has everything Stan wants to. And right now you would have been loaded and ready to go, full aboard on your move to target. And right here, I see another candle with a lot of volume. And Stan says it's the buying frenzy. Okay, right before I talk about this, there's one point I want to say. Man, there's a lot of information going through my head, but it feels good talking out loud there and recording this podcast. Pullbacks will happen more often on breakouts than breakdowns. So if there's a breakout, the high chances that there will be a pullback from 1 to 3 months. So it's kind of you kind of expect it. On breakdowns, maybe the momentum, the fear, it just drops rapidly, so you have less chances of having breakdowns. So maybe a situation where we have you could look, you see it right here, see the breakdown? Ooh, it never came back. Fear. So we might have to take that into consideration. If ever you have to position yourself on a breakdown, then you might not have the position. You might take investors or traders take the full position on the breakdown line, below the 30-week moving average and with an RSI trending downwards, like we see here. But on stage 2 going upwards, like a grind, right? Up and down, slowly. And you have a lot of these pullbacks, and then with the high volume, the buying frenzy, buyers, for whatever reason, they're interested in the stock. They keep buying and they don't want to miss out. And that's this new volume. You're creating new buyers coming in and driving the stock up, which for whatever reason, it's going to keep driving the price up. So it's pretty good. Yeah, another one right here. You could have entered, and if ever there was a pullback, in this case, the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months, 3 months later, a little more, it started pulling back. And on low volume, the pullback was on high volume. So maybe not an optimal pullback for you to enter. Or maybe it's getting too far away from the breakout, so we could just consider it a correction. Trader sell stop. Every time we had the correction and then move back upwards, put the sell stop under the V. Investors under the V, under the moving average, and below round number. So now it would be 49.99, let's say, right here. And where's the next pullback? What do we say? Okay, here's the first pullback for this pattern. Pullback, breakout, no more pullbacks. Correction, and move back upwards. Right here. So now you would have, okay, investors, you're still good because you put you don't bail at when you cross the 30-week moving average. Investors, they do bail when they hit the 30-week moving average. So how do we bail? How do we get our sell stops in? There's a swing rule. If ever we had a base head and shoulders bottom or double barrel bottom, and if we reach a target of that measured move, we take half a position. Trend lines, 3 points. 1, maybe 2, 3. And on the violation of the 4th point, we take half a position. Whether you're investor or trader, half your position here would be out. And right around this candle here, the trader would have taken the remainder of his positions. And the investor, that's where I get I don't want to contradict myself. I've tried to rationalize that investors, when it gets close towards the end, and especially that means if you have a trendline violation, you already take half your position. You have to assume that you're close to the end of the stage 2, or maybe there might be a consolidation period of a stage 3 and maybe continuation of stage 2, but you don't know that yet. So your sell stops, you start applying them as a trader would. So if that's the case, the trend line, the 30-week moving average violation, you would also have bailed at the same time as a trader right here. And that's really a question I have to dig in. But right now, that's what I would do. Best case, a stock does go into stage 3, it goes down, and then you're just happy and you got out. But worst case, you could just join in on a consolidation move. So let's say, okay, we're out here. Let's grab do our profits little lines. Okay, so you would have bought on this one here, half your position right here, and the other half a little lower. And that's what Stan says usually. The remainder half of your position, the trend line usually is going to give you the highest profits. And after that, it won't take long before you start getting into stage 3 sideways move, and then you get triggered out by the 30-week moving average, or you hit some previous sell stops that you moved up. So these are our two targets reached. And right now what's happening, let me create some black space. And yeah, there is another, I read this other post, and maybe other people had that reflection. Oh, it went up too high, can't go higher. Well, it's all a question of perspective, right? We don't know. But I could squeeze down my chart like that, and I see all that blank space. Oh, that looks so low. That's just a big, small, tight range, right? Base, look at that. 240s right there. So don't think about too much. It can't go higher because look, I could do it like that and just put oh, look, it's not going to go higher, man. Look, it's at the top. Well, does that really make sense? It's just I moved the chart. So try not to think about that. Just respect the framework, and that's all. I call that an emotional line mine. Don't overthink what might happen. Respect the trading framework. Stan's going to get you as high as possible until the 30-week moving average starts flattening out and then getting triggered out. And that's the end of the stage. It's the moving average. The price action pulls a moving average up or down. The further it is away from it, the steeper the angle of your moving average. The closer the price action to moving average, the less it's going to pull it, and the more it's going to flatten out. And that's going to do it. Not the chart, not what it looks like, not what you think, not what the moon is, the sun. That's all noise. Just respect your trading framework. Practice having a high emotional IQ. Don't land on those landmines of asking you questions, reading news. That's irrelevant. Data could be called A, B, C, A, D, and it shouldn't matter. All right, let's get back to this candidate. All right, so right now, sideways move, bounced off the 30-week moving average. There was some volume here. What's this candle here? So right now, this seems to have been a breakout candle right here. Stan also says breakout is just not a single candle with a lot of volume. He likes having a buildup of volume like here and sustained volume after. Tamper off during the pullback, but the move should continue having a sustained volume. So could have this been a breakout candle above? Yeah, we could have said back in the days that this was the resistance. That nice round number, 79, 80. We had a breakout, didn't look too good right away, and here's a formation. So investors would have had their sell stop here, right below the bottom of the formation, and the traders would have had their sell stop right below the 30-week moving average. This is a continuation move. If you can protect yourself, if it's too close, it would have been 4 to 6% below, which would have been maybe $4 to $6, $4 to $5, $4 to $6 maybe, $4 to $5. So it would have been at 75 or below the 30-week moving average. You could have, if you're an trader, you could have almost got triggered out by the, well, not if you put it under the 30-week moving average. Okay, that's another question on continuation buys for the trader. Where does he put his sell stop? Below the pattern, absolutely, or below 30-week moving average within the pattern. Okay, I'm going to rewatch this video at the end, and I'm going to write down those notes and get some more answers to more questions. But the more questions I get answered, the more precise I am with the trading framework, and the more efficient it's going to be. So that's a plus. And hopefully maybe these videos could serve some other people as an encyclopedia of knowledge to complement what stageanalysis.net has done and other contributors across the web. Okay, let's say you're still in, pull back, and now we're here today. Pull back and price action goes towards the top. Investors could have moved here under 30 moving average. Traders also, if ever they had to put it below that the consolidation pattern. So I guess this is good, man. This is a good we could enter here on a continuation move. So right now I see this as a stage 2 continuation move, and it seems to have gone through what another concept I called the wall, previous support turn resistance. Right here we had a breakdown, support, and now it becomes resistance, and the price action has closed above that. I think this is a very good candidate to enter on a continuation buy. But since I didn't enter here, it doesn't really matter, but I could still participate. It's still a good place to enter the trade. All right, okay, you're on the list. And this was very instructive. I learned some stuff, and keep asking myself some questions, but I'll get the answers. All right. Until next time, guys. See ya.